Good morning, good afternoon, everyone. This is Rob Barnett. I'd like to welcome you to today's BI Energy Exchange. We're doing these weekly now, so hopefully that works for everyone. Feel free to drop in, drop out at your discretion, but we've got a broad global team that we really want to get you exposure to, and there was no way we could fit everyone on calls that we were just doing every other week. So we've got so much research output that we wanted to make sure you got the exposure to the broader global team. So on today's call, we've got we'll go around the world. We got Patricio Alvarez over in London joining us. Then coming over to the States, we've got Vince Piazza from an undisclosed location in the Northeast, and we've got Fernando Valle joining us from 731 Lexington. We'll just do a quick check-in on where some of the commodities are at. Oil looks like it's over 90 today, or at least Brent is 91 and change. European gas looks like it's flirting with 50 euros a megawatt hour, about $15 per MMBTU type range. So much higher than where Henry Hub is at. Okay, so that's commodity backdrop. One of the things that is a big deal in energy land, and I think we're still sorting through the ramifications of it, is Exxon and Pioneer's recently announced deal. We heard what Fernando and Spencer Cutter and some of the others on the team thought about that last week, but I want to come over to Vince and get your thoughts on it since you cover Pioneer. And what do you make of the deal, and do you think it's something that's sort of the leading edge that's going to kick off a wave of M&A activity in the space?
Yeah. Hey, thanks, Rob. Good morning, everyone. Good afternoon to all of our clients out there. Yeah, we've spent a lot of time talking about this internally, and we've published on this extensively as well throughout the year and even before recent rumors. Look, I think we're at that point for the independent space where we're past that growth phase. We're in that shakeout maturity phase now, where the independents are trying to figure out what they really want to be. In the case of Pioneer, they went through their consolidation phase up in the Permian. They got rid of a lot of the ancillary outside the Permian assets, and they began to concentrate on the Permian. They did the Parsley deal, they did the Double Point deal. They really bulked up in the Permian. And it was my opinion that there were only a few people who could actually buy them, and more likely they would be one of the survivors. That wasn't the case, but they did bulk up. It was a pretty big check for Exxon to write. But in general, when you take a look at the landscape in the Permian, or really other areas as well, you're going to have fewer but larger players in the plays. And I think that's the case more broadly. Diamondback is another operator that consolidated as well. They are likely to continue to consolidate in that play. You have a lot of smaller operators below that 250,000 net acre bucket. They need to better appreciate what they want to do going forward. We will likely see corporate on corporate of equal size trying to combine and buy themselves some time. 80 handle on TI and a 350 handle on gas, even though Waha is at a steeper discount, that buys you a little bit of time. But at the end of the day, we're likely going to see even more consolidation as the publics get larger. You also have private assets that are out there, the PE shops, looking to monetize those earlier vintages, and they're likely going to need to offload these assets for paper. So, for example, take Diamond Paper or take a Pioneer Paper. So I think you're likely going to see that continue. It's not only in the Permian, though. We're also going to see it out in the Marcellus. EQT did it. And now Southwestern has been rumored to be in talks with Chesapeake. Again, those are just rumors out there, but that makes sense as well, right? You want to consolidate and you want to concentrate those assets and that would give a potential tie-up, extensive resource in the Haynesville and also in the Marcellus. So this continues on. You have this shakeout, this maturity phase, all this sunk cost to delineate the asset, and now it's okay. How do you survive an environment where it's much more politically fraught, and you're also going up against civic backlash as well?
Fernando, I want to come over to you and just sort of get your take, since you cover some of the integrateds. One of the classic constructs, I think, of an oil major was that you're sort of spreading risk around the world, and you wanted to avoid geographic concentration for a variety of reasons. And do you think that the U.S. is still an attractive growth market for where you would want to have a large production base, or do you think companies sort of want some of that, but they're also going to be looking internationally as well as they seek to sort of boost output over the years ahead?
It's a great question. I think the Permian still is, but outside of the Permian, it becomes increasingly challenging, not just because of the rock itself, but the regulations. Obviously, the Gulf of Mexico still has significant resource potential, but the regulations there and even the government take itself is elevated relative to other parts of the world. There aren't any real emergent oil plays that can have the same kind of size and scale of the Permian. So I think outside of that, it'll be very limited. So I do think majors will look abroad and will look into places like Brazil again, and Guyana also and Suriname becoming a bit of a hotbed. The question is, if we go higher, the places that have high government takes, PSCs like Western Africa, come back into play. There's the North Sea, which has stringent regulations, come back into play. And I think they will, just because the first areas that you go to after such a period of under exploration are the ones where you know there is oil and there's potential to either do tie-ins or just step outs into new reservoirs. Also highlight Namibia, where Total is made a significant discovery, and there are other discovered resources in that basin. It's one that is supposed to have a lot of analogs with Brazil's pre-salt, so it's an area of a lot of interest. I did an IPO in 2011 for a company that had a lot of exploration in Namibia, so it's an ever-promising land that's never actually developed an oil field.
Patricio, let's switch gears a little bit and bring in the gas side of the equation. And so I think the tie-in here is that outside of Norway, I don't think there's a lot of domestic gas resource in Europe at the moment, maybe some in the Mediterranean. And so getting the balance on supply demand for gas in Europe has been a bit of a tricky thing when you layer on the conflict in Ukraine and perhaps now the conflict between Israel and Hamas. So how do you see the gas side of the equation playing out and where's the supply going to come from as you look out into the next 12, 24 months?
Sure thing. Thanks, Rob. So I think a good place to start is to give a bit of context or dimension in terms of how much Europe's gas balances depend from North African pipeline flows. That's roughly 10% of the supply, or for a forecast for supply this year. That comes mainly from Algeria, and we also receive a few LNG cargoes from Qatar. So it's a mix of both pipeline via Turkey and also via Spain, and we also get a bit of LNG from Qatar as well. So from that state of things, we see a backdrop of very, very robust storages. So we are actually tracking above what storage was doing this time last season. So we're actually at record high levels historically at 98% full at the moment. And according to our analysis, there's not really a big sort of a spillover risk from the current situation. The suspension of the Tamar gas field in Israel will constrain exports to Egypt. And that, in theory, could constrain Egypt's ability to resume exports of LNG into Europe. But that said, I think it's important to note that Egypt suspended LNG exports to Europe since June. They have been halted since then, but the region has seen storage levels still increase to 98% full, and that's mainly because demand is very weak in Europe, both on the industrial side. So industrial demand keeps tracking almost 20% below its long-term range, and there's no signs of recovery yet. Especially in Germany. And on the weather front, weather has been very benign to us in Europe and has continued to be so in October. So October is really when the heating season starts to kick off here in Europe. But so far, weather has been milder than average. And if we look at the date today, it's 18th of October, I'd say that the heating degrees here are still, we've pretty much bought almost a month's worth of demand in terms of heating. So on that front, there doesn't seem to be a really big risk at the moment, although we do note that if the conflict escalates or expands into other countries in the region outside of obviously Israel, then that could affect us either from the production perspective by taking away gas production in Egypt, and also if there's any disruptions that could affect LNG cargoes passing through the Suez Canal.
Patricia, I just got to follow up because you paint a pretty mild picture there. It sounds like everything is working out from a sort of fundamentals balance perspective, but the gas price has been ticking up. So is it just geopolitical fear that's creeping in? What's driving us back up into the 50 euro per megawatt hour, $15 per MMBTU range?
So I think that's a great way to put it. I think it's both sort of geopolitical jitters or kind of the threat of this conflict escalating and constraining other parts of the supply value chain that may end up hurting us here. On the other front, you have sort of like the underlying seasonal demand, or like we're swooping into the heating season. Like it or not, it has been mild, but the heating season will begin soon. There's colder weather forecasts for next week already. There's also been some uncertainty over outages in Norway that were extended and recently resumed. There's also sort of a flowing situation with the LNG strikes in Australia, which have been called off, then resumed. And now, last time I checked, they were called off again. So it seems like the market is still very nervous, and there's sort of a geopolitical risk premium right now. Although the fundamentals would suggest that prices at the minute are a bit above where they should be for the demand in the near term.
Let me just add on that end, though, that there's also on the diesel side, which is the backup to the backup, we are low, we're around 7% below 10-year levels in Europe and 15% below those levels in Northeast U.S., which it creates a concern if we start depleting natural gas inventories. In the U.S., there's no significant natural gas inventories in the Northeast of the U.S., and so that is an even bigger issue. If you look at the past 2 years, we've pulled a lot of imports of diesel in February and March into the U.S. It's the peak of diesel imports, both the last 2 years, and that was with a fairly mild winter. So it's certainly a reason for concern on that part of the world.
Fernando, just a quick follow-up there. I think for many years, we often thought of LNG as kind of having more oil-linked pricing, which I think you're kind of hinting at there. Is that linkage broken at the moment, or kind of how do you, because gas kind of had its own life, particularly in Europe. So how do you think about the relationship between whether WTI Brent and say not Henry Hub, but TTF or something along those lines?
Yeah, so most of the Far East contracts are done on a Brent slope or a Japanese crude cocktail slope, so the 14% slope of prices. So that linkage is there. As we get more and more spot cargoes, especially from the and cargoes from the U.S. that are either Henry Hub linked or TTF linked, that's diminished. But most of the Asian contracts are still they still use a crude linked slope. So there is certainly that draft, and because we're still developing the trading market in LNG, where they can change they can change a cargo to a different location depending on pricing. It still has a weaker but a still strong link to crude prices.
Okay, Vince, we're going to come over to you. Vince, you've been covering the U.S. gas market for quite some time. I'll just preface just quickly that Henry Hub's just over $3 per MMBTU. What Patricio was talking about in Europe is over $15 per MMBTU. What do you make of the U.S. market as we head into winter? Is it a completely different set of fundamentals here?
Yeah, so we became much more constructive on U.S. nat gas after last winter. We had spot somewhere below $2, and so we jumped on that pretty quickly. And interestingly, the summer season really didn't help much until things got really warm at the end of August and into September. Balances did tighten up. Freeport is back online. We didn't have that last winter, last season, and things are starting to look a little better. This week we gave back a bunch, but we put out our winter nat gas view. We thought more of a 4 handle is much more reasonable relative to where we see things. Natural gas growth, production growth is ebbing. Rigs are coming off. Rigs have been coming off most of the year. Frac crews have been idled. So on the demand side, growth in LNG, obviously the maintenance cycle and Freeport coming back, that's a positive. Nat gas in the stack, in the power stack, they're taking much more share as well. So that's more of a structural secular shift. If I take a look at nat gas strips for 23-24 winter, they were in the 350 range before this week. They were ticking up to about 360. So for us, I think, depending on how these next three weekly reports go, I still think we have a better setup going into the winter cycle. Our call is that we're going to end somewhere around 3.7 for injection season. We were trending a little bit above that, so a little bit off of our estimate, but we still think heating degree days are going to come in about 3-4% above last season, and that should drive roughly about 2 TCF, just above 2 TCF of draws from storage, and that should leave us somewhere around 1.6, 1.65, depending on how things shake out. The last time we had that scenario, we had marks well above 4 average for the winter cycle. We don't think it's going to get that aggressive, but we still think we're happier looking at the 4 range as opposed to the low 3s. That's where we shake out. So far, we've been quite fortunate on these last couple of winters, and also on some of our summer calls as well. So I think we feel pretty good going into the winter cycle. Of course, it's really going to come down to the cyclicality of the winter weather. We've had 2 or 3 relatively warm winter seasons in a row so far. So I think we're due for a little bit of cooler weather, and that could drive some sentiment. That could drive tighter balances, and hopefully it drives prices as well.
Vince, I just want to remind our clients who are on the call here that we have this thing called focus ideas, and focus ideas are kind of highest conviction out of consensus calls. And back when gas was, I think, sub $2 per MMBTU, you put out a focus idea on the gas market, and I actually don't know if you still have it open or not, but for anyone who's listening, you can run BI Focus on your terminal. You can go check out all of the focus ideas we have on energy, not just Vince's, and kind of look through some of the research and kind of see where you were at earlier. But I did want to follow up on your idea, Vince, and just query a little bit and get a sense on the equity side of the equation. Are gas weighted producers in favor at the moment, or is there sort of a preference for more liquid heavy producers on the sort of company equation? Are gas heavy producers punished at the moment, even with a more robust outlook, or kind of how do you see that shaking out?
Actually, the gas heavy producers that we cover, the Appalachian names and some of the Haynesville guys, those have done fairly well this year. But as a former buy side guy, everything flows with TI, right? That is that stirs the drink. So as TI goes, so does all of energy. Energy had a great 2021, had a great 2022. The first half of the year was kind of rough. Because nat gas through the first 2 quarters was roughly off about 40 some odd percent. 3Q was a lot better. Obviously, it was a lot better thanks to a rebound in gas, but also the bigger driver was TI. Yes, the nat gas guys have done well in 3Q. The Permian oil guys have done even better off that rough first half, especially now with consolidation in play. But we're not looking at big premiums to be paid. But still, that sort of offers you a floor on the valuation side, so you can have better support. But the upside is really going to be, tell me how winter shakes out and tell me how TI shakes out here as we bust through the 80s range. And when we were at roughly 360, 370 gas just a couple of weeks ago, even the Appalachian Haynesville gas guys did fairly well. But TI will drive the debate.
Okay, thank you, Vince. I'll just note here that the MSCI World Energy Index, pretty oil-linked securities in that basket, up about 5% year to date. So, mild upswing, and it's really been on a kind of run since May or so. If you're kind of just looking at the price chart, but given you, Vince, mentioned kind of previews how 3Q was. Fernando, I want to come over to you. We're entering earnings season here. Lay the land for us in your coverage area. What are your expectations? How did 3Q look, and how do you see the remainder of 2023 shaping up for your names?
Sure. I think 3Q definitely looked better than expected for the most part, and easiest to point to Exxon's guidance, especially on the upstream side. It was well ahead of consensus. I think everyone missed just how much of the upswing will impact positively on their margins, and I think that'll be true for a lot of the other producers as well. It's not going to be as good as 2022, but then again, most numbers aren't going to be. The refining side is quite the opposite. There was also an improvement in the third quarter versus the second quarter, especially on crack spreads. But one of the things that makes it more difficult for refiners is that the Brent WTI discount really narrowed significantly. And some of the other crudes as well, WCS from Canada, those differentials narrowed a lot, and that will impact refining margins. And then on the ancillary segments like renewable diesel, Brett Gibbs has a big call on that that we've worked on a lot, that we think RINs are oversupplied. especially on the biomass side, and that's already started to play out. You went from $1.60 per RIN to 79 cents. Now it's hovering around 85. So the margin for renewable diesel producers is really struggling, and we think that will continue over the next several months. And then the two smaller segments, petrochemicals and lubricants, have been really disappointing, not just on Exxon's guidance, but also if you look at all the benchmarks from Valero to HollyFrontier, or rather HF Sinclair now, their benchmarks have all shown very significant contractions. And as Pat was mentioning, industrial use in Europe being 20% below the norm, that's to be expected. I think those are maybe the canary in the coal mine a little bit, and that's why we get a little bit bearish on crude itself in the short term, because you can't have that kind of drop in petrochemicals, for example, that's heavily tied to construction, heavily tied to durable goods orders, and not eventually see a repercussion on crude itself. And I'll just end by mentioning gasoline demand in the U.S. it's showing a lot of weakness. I know that the past 2 weeks are probably more of a blip on the data, but even if you just look from July onwards, it took a very significant dip because the affordability was a problem. And now, as student loans resume and mortgage forbearance and mortgage rates being higher, we think it's going to be a real struggle for the consumer to return to the 2021, 2022 levels.
Fernando, I want to echo kind of what you just said about the kind of consumer and tie it into the solar and wind space real quick. So I think the thing to be looking for on the solar side of the equation is demand has been growing by these astronomical numbers, almost like absurd, right? 50%, 30% year over year growth rates. And I think we are really starting to see a slowdown, particularly on the residential side of the equation. Most solar systems are financed, so higher interest rates, real headwind there. So I would say a little bit of a slowdown on top line. Still should be fast, but maybe not as fast as it was. And perhaps a little bit of margin improvement in some parts of the value chain. We've got a lot of our previews out, so it's a bit of a mixed bag depending on whether you're kind of at the developer side or the module side. But take a look at our previews there. And just quickly on the wind side as well, we've seen some pretty interesting pre-released figures out there. So Vestas, we already know, booked more than 4 gigawatts of new orders in 3Q, which is more than double of 3Q of last year. And there's some seasonality and sort of factors that play into that. But we're expecting pretty good growth in backlog order book. Steel prices have been coming down, sets up the sort of view that margin could be improving because steel's a big input cost for the wind names. And Vestas, by the way, is a company we've got a focus idea on. So if you hit that BI focus, you can take a look at kind of how we see the narrative playing out there. So next, I want to come over to Patricio. You've also, like all of us, been getting sort of ahead of the current earnings cycle. What are your expectations, Patricio?
Yep. So third quarter results for European utilities tend to be relatively uneventful, given that it's a shoulder season for power demand. But things to note or things to flag is that fundamentals for regulated utilities continue to be benign, especially in this higher interest rate environment. Given that a lot of the returns of the grid operators here are indexed to inflation, and if anything, we're seeing a bit of lagged remuneration effects from last year trickling down this year, which complements their sort of underlying asset-based growth. In terms of power generators, we do note that power prices have come down quite significantly year over year. but the hedging backdrop is still fairly supportive for them, with power prices in Germany trending towards the €100 per megawatt mark. That is still almost twice as much as what prices were doing before 2021. So power prices are still supportive for the generators, and I think we will pay special attention to the renewables, to the renewable focused peers, mainly those with exposure to offshore wind in the US, given the current headwinds there. I think perhaps the sort of the bad news on that front are not done yet, although we do see emerging sort of regulatory tailwinds in the new 10-step plan developed in New York State, which is aimed at sort of mitigating the dislocation between the time a developer signs an agreement and actually starts to build it. Although it's very early, it at least lets us know that the regulators are still sort of willing to foot the bill, if this makes sense. So those are the things we'll be paying attention to over the next earnings cycle.
Okay, thank you, Patricio. Vince, I want to give you just one last opportunity to talk your book. Anything else kind of in the 3Q realm you're looking at when you look across the names you cover?
Yeah, so we highlighted a couple of private names that we followed tangentially, especially out in the Permian, that at some point look to be most likely M&A targets down the road, just given all of the M&A that we've seen. You could hear names like Endeavor, Newborn, Crown Quest, Crown Rock being talked about on some of the conference calls for 3Q and beyond. I think consolidation is going to be still the major issue. Capital allocation in 2024, we'll likely get a couple of hints about how that's going to look like. Free cash flow is actually down 2023 versus 2022. But if things continue along the current path with the improvement in TI and natty gas, you could see that turn around some for 2024. So you could see additional discussion about dividend growth, both the base dividend and supplemental dividend, and buybacks, which has always been a tough topic for us to talk about. It is the bane of our existence. But overall, balance sheets look a lot better for the group. So it's not going to be an issue around leverage. Capital raising could be an issue, but for the most part, the balance sheets for the group are in great shape. A lot of the deals that are being done with elevated equity as a currency. So that'll likely continue as well. But consolidation is still going to be the major theme on these conference calls heading out into 3Q and beyond.
Okay, I think we're going to have to leave it there. So I would just do one more plug that on the terminal, on the day that earnings come out for any of these companies that we cover over 2,000 globally. We write an earnings outlook that's not a summary of what we just heard, but more of kind of, okay, we just heard that, now what's next? So make sure to check those out. And if there's something very material that happens at a company that is a surprise or something that we weren't anticipating per se, we will do what's called a react. And that's where it's kind of, as soon as the earnings come out, a very sort of brief, here is the take of the analyst covering the company. So whether it's the reacts or the earnings outlooks and kind of keeping our research on the equities up to date, make sure to check out our primers, including all of the sort of supporting material that goes in it. And I would just note that we are all green dots on the terminal right now. So if you have follow-up questions, shoot us an IB. We're happy to talk about any of the material we've discussed here with you individually. And make sure you're checking out all the great things on the BI research landing page on the terminal. So I hope everyone has a great week, and we'll talk to you next week. Take care.
Thank you. Bye-bye.